Probably the most important things I could say on this call is that it's a very attractive environment for income generation. Yields are attractive. I say this in a historical context. Back when we had the last inflation shock, coming out of the COVID period, starting high quality bond yields on a global basis were down in the 1% to 2% range. That's very different today. Even with anticipated higher inflation over the course of the next few quarters, most high quality bond yields are well above those inflation levels. So you have this yield cushion, and our overall positioning or interest rate exposure reflects the fact that not only did you have exciting and attractive long-term valuations, you've also now been able to take advantage of, and we've been able to take advantage of, a pretty significant spike in yields in certain high-quality bond markets in response to the conflict in Iran. So when you look at opportunities across the developed world today, government bond markets, offering 4.25% to 5% type intermediate-term yields. You attach even a safe spread to that, and you can quickly get up into the 5% to 6% range, and then through some other creative portfolio construction, get the yield even higher than that. So that's really the foundation in terms of our thinking, is that you don't have to predict what central banks do. You don't have to predict when the crisis in Iran is going to be reconciled. You can just take advantage of attractive absolute valuations within higher quality fixed income, as well as very attractive relative valuations. If you compare today's level of yield versus credit spreads versus equity valuations, again, history is really on your side in terms of being able to generate, attractive base case returns and very attractive relative returns as well. Second point we talked about, extreme macro uncertainty and policy uncertainty. Macro uncertainty, for financial professionals is arguably easier to analyze. But when you're talking about politics, you're talking about war, you're talking about the possibility of significant deterioration in global geopolitical relationships, that's a bit harder to forecast. And you have to accept the fact that we are in a highly uncertain world, and that uncertainty is not going to get resolved over the near term. We also, combine that with, pretty stretched valuations still in the riskier segments of the credit markets. You throw in some AI disruption and elevated elevated equity valuations. We also think it makes sense for our income strategies to stay up in quality, stay diversified, but resist the temptation just yet to shift into a meaningful allocation to the more economically sensitive areas of the global bond markets. So that second theme is up in quality, and related to that, a global diversification, outside the United States, taking advantage of a full global opportunity set. Then the last point, is liquidity. Liquidity means future flexibility. And when you're in a world where credit spreads are tight and macro uncertainty is quite elevated, maintaining liquidity means future portfolio flexibility. It means that we'll be able to, in certain scenarios, provide liquidity to others that desperately need it. We think that the strategy is set up well to take advantage of what very well could be very exciting opportunities associated with this dislocation.
A big picture question we get a lot is how should investors think about fixed income allocations today, and what kind of risk return profile should they be thinking about, especially within the context of high quality bonds going forward?
Anytime you have an inflationary shock, your conviction level in terms of short-term performance goes down. It's just the natural impact of this source of uncertainty. But that should be true for risky assets as well, credit spreads or equities. This is an environment not unique to fixed income in terms of near-term challenges. It's true of financial markets pretty much across the board. But when you look at starting valuations, if you simply plot starting valuations today in the fixed income marketplace versus where they've been the last couple of decades, you'll see a meaningful valuation cushion relative to elevated inflation rates, relative to the level where global equity markets and certainly U.S. equity markets are trading, relative to the starting point in terms of credit spreads more broadly. When you go out and look at what future performance has been when you've had this type of valuation cushion, absolute and relative, history is very favorable to fixed income strategies generating attractive returns. You couple that with a flexible strategy like our income strategy and target opportunities across the global opportunity set. that can take advantage of not only attractive starting yields, and this is the misconception that somehow because starting yields are at a certain level, that's what you could expect from fixed income. For a flexible strategy like income, I think you can view it as a longer-term floor with exciting opportunities to generate incremental alpha, incremental performance from shifting your asset allocation over the course of the next several years. So again, a lot of near-term uncertainty, but for investors in the strategy that have a 3 to 5 year type horizon, the future looks quite attractive.